Hi, I'm James Brazil, and I'm excited to be with you here today in our Roseville office. And I've got another member of our team here with me today, and we're here to talk about the Tax Cut and Jobs Act of 2017.
And I'm Jim Brazil from Chico, but I'm in Roseville, because we thought we would get together and show you what we have learned about this new tax thing and how it's going to affect you.
Yeah, I'm pretty excited to go through this. We've been together for 27 years now, and in my entire career, I've pretty much been under one tax regime. There's tweaks and changes all the time going through, but this is really landmark legislation that basically at the beginning of my career in 1986, after graduating from college, is when this tax system had been under was in place. This is probably the biggest change since that time.
The last tax bill was in 1986, and it took a long time for the changes to really be realized in what there were. And that is 30 years ago, roughly a little over 30 years. When we saw this tax bill, we realized that this was a radical change. And that it not only was a change, but it was really going to affect every one of you in many different ways. And the thing that you need to think about is it's effective right now. It was passed in late December, and it's effective for 2018. And it has a lot of what you call sunset clauses. It goes for a while and then it stops. So it's going to be very complex to understand, and we think what we've done, at least that's what Jim and I think we've done, we think we've been able to put it together to where you can follow it. I will tell you, you should probably watch this whole video, and then you should go get your tax return, either 2016 or 17, and then you ought to watch the video again, and we'll show you why. I think it also should tell you where we're getting the information. Probably like a lot of you, you've seen articles in newspapers and magazines, and of course we've looked at them, and let me just give you some of the titles. Discussing the potential impact of the new tax law with clients. Rich professionals can exploit tax break for farmers and small business. Make taxes great again. There's a title. Here's where have all the deductions gone, and we're going to cover that. Here's the Trump tax loophole the accountants can blow open. Confusion surrounds the new pass-through income deduction. Tax law brings big changes for alimony payers. And this one's pretty good. Tax cuts create Social Security torpedo retirement income juggling act. And it goes on and on. On the internet, there's a number of sources. Here's one, and it's generic, but it's pretty good. The Wall Street Journal put out one called The Guide to the New World of Taxes, and they go through a whole lot of areas affecting people, and they give you a good generic overview of what's going to be affected. But we're going to rely pretty much on one book. And you'll notice that Jim's got one and I've got one, and I won't tell you what they cost, but they were fairly expensive. And I want to read you from the first page so that you get an idea of what we're using as a reference material. On December 20th, 2017, Congress passed the Tax Acts and Jobs Act, and you might see the letters PL and 115-97. That's the public law. After a 51-48 vote in the Senate and a 224-201 vote in the House, President Trump signed this bill into law on December 22nd, 2017, and that's roughly 90 days ago. And it became effective January 1, 2018. So we've been operating for 90 days, and almost no one knows what's in the tax bill. The Tax Cuts and Jobs Act represents the most significant overhaul of the Internal Revenue Code in over 30 years. It provides significant reductions in tax rates, which we'll talk about, corporation and small business, reforms the U.S. taxation of international transactions, which few of you will be involved in, And here's the kicker. It eliminates dozens of individual and business tax deductions. Every U.S. taxpayer, foreign or domestic, individual or business, high income or low income, is impacted by the provisions. And this is the book put out by C&C Productions. Covers the law, it covers the old law, it covers the committee reports, and it covers everything that people are affected by. So that's what we're going to try to cover today.
Yeah, this CCH book and the provisions in there that he just alluded to, talking about deductions, is a major, major change. And part of the goal of this tax plan originally was to, in theory, simplify things. And there are a number of areas where it's simplified. There's going to be less to fill out on your tax return. But unfortunately, by simplification, it's elimination of a lot of deductions. So we'll be diving into that here in just a moment.
So let's start by the form you're familiar with. And the 2 pages that you're most familiar with are these right here. This is the first 2 pages of your Form 1040. You'll notice on your left, my right, this one here, that it covers the income area that comes in. You'll notice that it also covers adjustments to income. On the other page, it says tax and credits, and that's basically the 3 areas we're going to cover. But there's also another form that you're very familiar with that you spend all your time getting together, and that's this one here called Itemized Deductions, Schedule A. And this is the one that's going to drive you nuts, because this one has got some really major changes. But let's start at the beginning and walk you through some of the things. And I'm going to make a suggestion. Watch this video to the end. Then get your tax return out, either the 2016 or the 2017, and look at your own return as we go through this. And we'll also offer to you that when you get your 2017 return, if you get us a copy, we'll run it through and see the differences under the 18 law as opposed to the 17 law which you're filing.
Yeah, so what I'd like to go through first are those income items on your 1040 tax return. So lines 7 through 21, I believe, on the 1040 go through income. And a lot of those are going to remain roughly the same. Interest, dividends, wages, those numbers just come over and get entered on your return. But there are a few areas that are going to get impacted dramatically. And one of them that my dad and I went through that seemed quite intriguing was with regards to alimony. And Dad, I know you've dug into the book a little bit, and what's happening with alimony?
Well, it's very interesting. First off, let's just say that if you get divorced before the end of this year and you get an alimony settlement, then you can take the alimony deduction off of your tax return, and the person receiving the alimony will pay taxes on the amount they receive. This is one of those things that I don't quite understand. First off, if we go to the book, we see that a little over 600,000 people in the United States report on their 1040 a deduction for paying alimony and a taxable income. Now, the theory seemed to be that the alimony was normally the result of a lot of negotiations, and the person who paid alimony was generally in a higher tax bracket. So therefore, they got, in theory, a bigger tax deduction, and it wasn't made up by the tax being paid by the donee, because the donee, in theory, was in a lower tax bracket. Now, as far as I know, I've never heard it any differently, but when we looked at the book and we went back to what the committee was thinking, I thought this was very intriguing. The House committee decided that alimony and separate maintenance payments are not deductible by the prior spouse. The House bill repeals the code provisions that specify that alimony and separate maintenance payments are included in income. Thus, the intent of the provision is to follow the United States Supreme Court's holding in Gould versus Gould. Now, I know you've all heard about the famous divorce case, Gould versus Cool, because it happened in 1917. So in 1917, Supreme Court in 245 U.S. 151 said that you couldn't deduct alimony and you didn't have to pay tax on it. Well, along comes the late 40s, and Congress passed a bill and decided that it was an economic thing that should be in the bill. So from about 1946-48, everybody that paid alimony got to deduct it, and everyone that received it had to pay tax on it. Along comes this tax bill, which I totally don't understand. But what really got me was the fact that if you get your divorce this year, it's a deduction. If you get your divorce January 1, 2019 forward, it's not a deduction. But now the rest of the story. If you currently are paying alimony or receiving it, and for one reason or another you go in and want to adjust it up or down, because a lot of times we've seen people who are making a certain amount of money and they start making a lot less and they go in and adjust the alimony down. If you make an adjustment on the alimony after the end of the year, and now, then it's not deductible anymore, unless, and this is really interesting, unless both sides agree. So a lot of commentators say one concern is that the loss of the deduction will cause alimony payers to negotiate lower payments, and for those that go in for an adjustment, it's going to be a whole new case. It appears to me that almost everybody receiving alimony will want to adjust it up or down because the person paying is going to lose their tax deduction. So I don't understand this one at all, but this is going to affect roughly 600,000 people. And some of our people are either paying or receiving alimony.
Some of the other areas of income that are particularly significant in this new tax law is around business income. We've all heard some about this probably in the news, but the pass-through entities, these are sole proprietorships even, but also LLCs, partnerships, these entities are going to get a 20% deduction. But this is one of the most complex areas. In fact, in our book here, and looking at the tax law, it has by far the longest explanation of any of the provisions in there. It has 14 straight pages just trying to explain what this provision will do and who it applies to and doesn't apply to and how it's phased out. And so this is something that's really more than we want to cover today. We'll cover this item at a future discussion.
A couple of other items on the income that we'll also get into. As we said, we almost have to run your tax to do this. But items 15A and 16A are IRA distributions and pensions and annuities, and how much comes in and how much of that is taxable. And that's going to be a very critical area to work on because when we get to itemized deductions. And also 20A, Social Security benefits. Most of you know that Medicare Part B is based its fee on how much your income is. So the greater the income, the more is deducted out of your Social Security for Part B. So one of the things that you want to do in planning is to reduce the income as much as you can. And there's a real coordination between IRA distributions, pension distributions, and Social Security benefits and the income up here. And that's what we'll need to do with you individually, because you've got to plug everything in for each person, because there's no general rule. Hopefully, most people can reduce their taxes by paying attention to those two areas.
Yeah, and then when, once you work down through the first page of your tax return and you've added up all these income items, then there's a section of deductions that appear there that are what we call above the line or before adjusted gross income. So these are fantastic because a lot of things that you receive in the tax return get phased out or reduced based on your adjusted gross income. things like you were talking about previously with regards to Medicare, how much the payments are, and Social Security benefits. A number of these are affected by adjusted gross income. So any deduction received prior to adjusted gross income can be very useful. There aren't a tremendous number of changes in here on the 1040. There are a couple of areas. One, again, that we've touched about before is regarding alimony. Here is a section for the people that are paying out alimony and we're able to deduct it on the tax return. And of course, going forward, that could be very different starting in 2019 where there's a loss of deduction on alimony. And then one other area doesn't affect people on an annual basis, but occasionally if you move for a job, there's the loss of moving expenses for essentially everyone when it's a job-related moving expense. And these adjustments to income prior to adjusted gross income, you get to the bottom of your tax return, line 37, adjusted gross income, and a lot more excitement actually from a personal income tax preparation standpoint occurs on page 2 of your tax return.
On that moving expense, we see they exempted military people, but we were very surprised on that one being taken away because that's a real big item for a lot of people whose company closes and moves to another location, and they have the home they've got to take care of and the move, and that's been an expense before to move your belongings from one place to another, and unless it's a military base move, it's not covered as an adjustment anymore, and that's pretty sad, that one. So then we move over to page 2, the page that you sign. The one that you always look at and moan because it also shows how much your tax is. But probably the most important thing on page 2 occurs right up at the top. And that's line number 40. So Jim, how has line number 40 been handled before? Now we only have the 2017 return, so we only have the numbers there for 17.
Yeah, line 40, you either choose between taking the standard deduction or the itemized deduction. And there's been a tremendous change in what you can take on your Schedule A itemized deduction. And we will walk through that because that's the critical changes. And then with regards to the standard deduction, they've completely changed the number dramatically, nearly doubling it to be $12,000 for an individual and $24,000 for a married couple.
That's opposed to the old $6,350 for a single person and $12,700. So like you said, they've almost doubled that standard deduction, which is going to, they predict it'll affect about 70-80% of all tax filers will never use the Schedule A anymore.
Yeah,
that's simplification.
Yeah, that's simplification. I'm not sure I want it quite that simple. I like the opportunity to deduct more of my expenses than having the standard deduction, but eliminating a number of these itemized deduction items. Now let's take a look at itemized deductions. We think one of the big areas on your personal tax return that changes have occurred. And in looking at the Schedule A that many of you go through and fill out, what we notice is the first item on there is medical and dental expenses. And I've actually found that this doesn't apply to many people because it's always had a larger threshold. Recently it's been 10%, and then for overage 65 it was 7.5%. But what they did in there, and it was kind of interesting, the House bill originally was going to eliminate the law as we're going through the CCH material here. So that said the House bill repeals the deduction for unreimbursed medical expenses. But the Senate amendment provides for the next 2 years actually lowering the threshold to 7.5% for everybody, not just those over age 65.
Now explain the threshold to everybody so that they get a use of what the threshold means.
Yeah, good point. So what that would be is on the bottom of the first page of your tax return, that's called your adjusted gross income. So let's just, to make a simple example, if that's $100,000, then for the threshold, if it's a 10% threshold, that would be $10,000. So you would need medical expenses above the $10,000 for you to be able to deduct anything. And that's why for many people, they never reach those thresholds. But we do know some of you have unusually large medical expenses, particularly those who are getting some assistance, either in a skilled nursing facility or having in-home care. It's not uncommon for people to be spending $8,000, $9,000 a month or more on medical care. And the original version of the House would completely have eliminated that for no deduction. Not only did the Senate want to retain it, but they actually lowered it to 7.5% for 2 years for everyone, not just those over age 65. And then after that, it goes up to the 10%. So that's kind of the top section on there. The next area, this is the big one, the big change, and that's with regards to taxes and the ability to deduct state taxes and property taxes on your federal tax return.
So he's going to let me do this one because this is probably going to impact more people. Let's talk about it first in a little more of a leisurely manner. It's called SALT. And you know the old adage, don't put salt on an open wound? Well, this is a salt in an open wound. This particular section is where you put down the amount of the California state tax that you paid, income tax, and this is where you put your real estate taxes down, and this is where if you have any personal property taxes, like boats and planes and that sort of thing, you put them here. When they passed this particular bill, they decided to limit that deduction to $10,000. Now that's interesting because the average number here in the state of New York is $22,000. 5 states have high income tax rates: California, New York, New Jersey, Connecticut, and Oregon. It's interesting that those states who have the high taxes, this is going to impact. We see a lot of tax returns where the combination of property tax and state income tax is $30,000, $40,000. That's now $10,000 limit. This is going to be an area that, if you do itemize, is going to really damage. It also is an area that's going to eliminate you needing to do itemized deductions because this is probably the biggest deduction on this page. So that's $10,000. Jim, what about your mortgage interest? Any changes there?
Yeah, well, one thing I'm not sure that you gave them the explanation of where you came up with SALT, the salt in the wound, but that's state and local tax is how people kind of came up with that acronym, or SALT. So now let's take a look at the mortgage interest deduction. Yeah, so the deductibility of interest is an itemized deduction for purchasing a personal residence or a second home. There's some pretty important changes there. One, they've lowered the amount from $1 million of total debt down to $750,000. And here in a very expensive state like California, that definitely could impact people. But another thing that I think will impact a great number of people, certainly going to affect probably the mortgage industry some, is with home equity lines of credit. How many times do we hear advertisements for people in the past promoting taking out money on your home so that you can do whatever you want with it, buy things, or even consolidate credit card debt by taking out a home equity line of credit? What they've done there is they've changed the deductibility of that interest to where it must be used for the purchase of or the improvement of your residence or a second home. So all of those home equity lines of credit people taking out to purchase a car, take a trip, just to pay other bills, that's been wiped out in this new tax law, and that could catch a few people.
You mean when I bought my sailboat, interest that was on the home, I wouldn't deduct anymore? Well, let's move on. We don't want to...
Let's not talk about that.
That's it.
No.
Okay, the next area is gifts to charity. And it's still pretty much the same. It stayed about the same. But I have a feeling that all of you who put a number down there, with the fact that you've got limitations on the taxes, the SALT area, and some limitations on interest, I doubt if most people will find that they can take a tax deduction for making charitable contributions. This is going to be a major impact to the charities in the United States because they certainly rely on large contributions, but mostly they rely on moderate contributions, $500, $1,000, $1,500, $2,000, $4,000, $5,000. And with the new exemption amount, I think most people who are going to make charitable contributions are going to lose their deduction for that under the way it's set up. We, though, know a couple of really good methods that we can advise you on how to still benefit by giving to charity and getting a real tax benefit by doing that, particularly those of you who are over 70, but even younger. I think we can show people how that they can maximize their charitable contributions in a way that they can still get a deduction on it. That'll be something we'll cover with them on an individual basis. Now, we go down to another area.
Yeah, and this might be a good point to kind of add right here when talking about the loss of being able to utilize the charitable deduction. Just kind of a simple example, a number of our clients who are married couples and they're retired, they would be, and they own their home free and clear because they've had it for a long time. The only things to this point they would really be able to deduct would be, if they don't have big medical expenses, would be their state and local income tax, which is capped at $10,000. And then if they really don't have any of these other deductions, for them to exceed that $24,000 threshold of the standard deduction, they would need to make more than $14,000 of charitable contributions before they could deduct a single additional dollar on the tax return. So this really could be a big impact to a lot of people.
And if they don't understand how they could still make their charitable deductions and get a tax benefit from it, they might be discouraged from making those contributions. And we'd like to tell all the charities, don't be too discouraged, because I think there's still some good, nice legal ways in the law to do that.
Yeah.
We've got another one down here that I'm fairly familiar with the people. And it doesn't sound like much. It's called casualty and theft losses. Mm-hmm. Now, most of us cover a little insurance to cover theft of personal property, and most of us cover insurance on our home if something happens. Well, it used to be that if 2 homes burned down in the area and the insurance didn't cover all the expenses to rebuild the homes, and you were out $600,000, but you only collected $525, you could put the other $75,000 here as a deduction against your federal taxes, which would be somewhat of a help. The other area I saw is personal theft, theft of an automobile, theft of personal property in the house, people going in and stealing. Insurance covers up to a certain limit, and then everything over that you could put here. The only casualty loss that's going to appear from now on line 20 of Schedule A, is a federally declared casualty loss that the government is providing assistance to. So there's two, the president can say, I declare it a casualty loss, but we're sending nobody in to help. Then it's not going to be covered. So the major fires we've had in California would be covered. The major flood losses we have would be covered. So if you don't collect enough back from insurance, you can make the deduction. But I bet over 80% of all the numbers that appeared in there before are gone, because those were personal, not federally declared catastrophic events.
Moving down our Schedule A, we end up with an area that we know as miscellaneous itemized deductions. So these are an area that is limited in the past to where your adjusted gross income, these deductions would have to exceed 2% of them. So again, $100,000 of adjusted gross income. If you have more than $2,000 of expenses in this section of the itemized deductions, then you could deduct them.
2% of, say, 100,000 of income. So if you had 100,000 adjusted gross income and it exceeded 2%, which is $2,000.
Correct.
Or if you had a $200,000, it'd have to exceed 4,000.
Yep.
And 300 would be 6,000. So a lot of people had items down in here. And by the way, this is one of the major areas you had to do all the research on. It was pretty easy. You had to look up your medical. The taxes paid was simple to gather. The interest on the loan, you had a piece of paper for that. Your gifts for charity you had to keep track of. Casualty losses, you had to work a little bit. But this is the area you spent most of the time in, because when you look down here, there's some really major items. And this is one that is very discouraging, particularly for the person who does two people, the one who prepares your taxes and us. Okay, and we hate to say us, but we're big in this one. They decided to eliminate the whole section. So there's nothing you need to learn to do. So what do you need to not pick up anymore? All the deductions that if you had a casualty loss or you needed to appraise something for charity, that cost, there's no section to put it in anymore. If you had a home computer you use for investments, there's no place to put it anymore. Investment fees and expenses, there's no place to put it anymore. Safety deposit box rental, it's not covered anymore. If you had an IRA and you decided to pay the trustee fees separately so you could get a tax deduction, it's not there anymore. That's gone. If you bought business liability insurance for that sole proprietorship, it's no place in there anymore. Now here's the one you're going to love. Dues to professional societies. There's no place to put it. It's not deductible. Educator expenses, with a caveat, you still can get $250 up in another section. But all those teachers and everybody that were spending $700, $800, $1,000 every year to supplement what the school wouldn't pay for so their students would have them, that's gone. No longer deductible. Home office or part of a taxpayer's home used regularly for the taxpayer's work. No place to put that anymore. You're searching for a job and you have expenses. It's not deductible. Legal fees related to your job is not there. License and regulatory fees. Medical examinations required by the employer. And a lot of employers say, I need a drug test. You can't deduct that anymore. Sorry, rural mail carriers, your vehicle expenses is not deducted. And by the way, all those subscriptions in the lobby of your dentist, your doctor, and your optometrist, subscription to professional journals and trade magazines related to taxpayers' work's not there. Tools and supplies used is not there anymore. Union dues and expenses aren't anymore. You can't deduct your work clothes. I'll tell you, I don't understand this one, because they've taken out a massive number of things that most families had a deduction for, and it's very interesting. The House of Representatives repealed the whole thing, not even thinking about it. The Senate amendment changed it to the 2%, and then they decided to just suspend the whole thing, and so the whole section's gone. I would say that is the most discouraging thing for most people, but I will tell you, if simplification is your goal, you won't have to hardly collect anything anymore, because if you use the standard deduction, you'll never use this form.
So it certainly could save people a lot of time
Yes.
by having that, but it may not save them any money.
So Jim, talk about if we don't use the Schedule A because we don't get it over the new exemption, then that's going to save people a lot of work gathering all their stuff.
Yeah, that will save a lot of work. And as we went through and studied this entire tax law, it's kind of interesting because, we started out looking at income items, and for the most part, those income items were staying the same or were being reduced, like in the case of business entities being able to pass through lower amounts of income. And so, that's a good thing. But then we start getting into the loss of all these deductions, and that's certainly a bad thing.
Well, what about personal exemptions, Jim?
And that's another area. So all of us on our tax return were able to take a personal exemption for each of the tax filers. So a married couple would have 2, individual would have 1, and then any dependents in the household, those would each be a personal exemption. And those were about $4,000 for each person. So that would get, in essence, kind of added to the previous standard deduction, and you'd come up with a deductible amount.
So in my tax return with Carol and I, we got $4,100. That's $4,050 for each. Mm-hmm. On your tax return, you got 5 exemptions over
well,
there.
Well, at one time, as the kids have gotten older, I didn't have as many, but yeah, at one time I had 5.
Which was $20,000.
Which was $20,000.
When the oldest one got out on her own, you had...
I had 4,
16.
16, and then 3.
And then 3
is 12.
And then
so
2.
That's where right now I'm at 3 total.
But that's gone.
Right.
There's no more personal exemption. So for Carol and I, that's a loss of $8,000. Mm-hmm. For you, that's a loss of $12,000 to $16,000.
Right.
Right there.
Right.
Okay, I'm not feeling too good, Jim. What about alternative minimum tax? Because I know they eliminated it on the businesses.
So on the AMT, they did not completely eliminate it, but they did make some significant, I guess you'd say, improvements to it on the thresholds and the amounts before you would hit the AMT. And of course, another benefit, I guess, the loss of a lot of these deductions means that the possibility of AMT kicking in, alternative minimum tax, is much less. So just in quick simplification terms, you would go through and calculate your tax on this method here, going through Schedule, or going through the 1040 and going through Schedule A itemized deductions and doing all of that. They would compare that number to an alternative tax system number. And under that method of calculating your tax, they would wipe out a lot of the deductions, like someone with high itemized deductions because of state and local income taxes. And then they would have that number to compare what your actual tax was. And if you didn't pay enough tax to where it would equal or exceed the alternative minimum tax, you'd have to pay this little alternative minimum tax calculation. Well, now, because the thresholds are much higher, and because the amount of deductions you're having are fewer, not nearly as many people will get hit by that alternative minimum tax.
So now we have one final item that's on that schedule that has been kicked up a little bit from what it was before. And we'll mention that because some of you actually have children. And it used to be you could take a child credit for $1,000. Now you can take a $2,000 for qualifying child. There is an interesting thing, though, on that, and that is that you also can take a $500 deduction for a dependent. For this purpose, a qualifying relative who's not a qualifying child, and you can get a $500. The dependent must be a U.S. citizen, natural, or resident of the United States. The $500 credit may not be claimed for a dependent who is a resident of a contiguous country to the United States, such as Mexico and Canada. So here's the child credit thing is doing a little bit of a new clarification as to what it is. Now, Jim, there is a good thing that happens at this point. The person now has their income. Some is up and some is down. They have their standard deduction or itemized deduction. They've lost their exemptions, and now it's time to calculate the tax. So when we start calculating the tax, is that good or is that bad?
Yes. Now we get to what is one of the good areas. And of course, this applies to everyone. We're down to the point where we're at taxable income. And for many people that don't have the reduced business income coming through, they're probably at a higher taxable income at this point. I think more people will be at a higher taxable income than a lower taxable income. But that's only the amount of income that gets taxed. The actual tax rates are lower for essentially everyone. We looked through the brackets and compared them, and there's usually a 1, 2, 3% differential of a lower tax rate than the current rate one would be paying in 2017. There is a small little section in there of about $24,000, $25,000 for someone earning around $400,000, where they would be at a slightly higher rate for just that proportion of income. But income tax rates, which of course is the last thing needed to calculate the tax, is a big plus for most people.
We also get into the fact that this is where you actually have to do the computation. Because what you've got now is the rest of these were hard numbers you put in, but the tax rate schedule, and most of you have never really looked at it because you just get a final number. But from 0 up to about 19,000, it's 10%. Once you make over 19, then it goes to 12. And then when you get up to around 50-some thousand, it goes to 22. So you have to calculate it. We're fortunate in that we have a planning software that will give us the ballpark numbers. And we've used it for a number of years where we see somebody wanting some more money and we decide where's the best place to take it, and we can apply it to the tax return to see if by taking it, say from the IRA, it's going to increase the Social Security Part B and increase their taxes, or if it's going to keep them in the same bracket. So this is the big reason you must get us your 2017 tax return. And there's a couple of ways to get it to us, Jim, so talk to people about how their best way for them might be.
Yeah, well, you certainly can print it out and bring it in to us. For a lot of you, it might be simpler to just talk to your tax preparer, and they would have a secure way of just emailing it over to us. But we really want to look at it now and not see it at the end of the year, or especially in 2018 or beginning of 2019 to see what happened. I think for just essentially everyone, some tax planning in 2018 now could be very beneficial to them on what they ultimately owe, because there's a lot of areas where you might want to make some changes to prevent your taxes from going up unnecessarily.
We've looked at a couple of 2016 tax returns. I ran my own because I don't have the 17 yet, because we're doing this right at the end of March and hope to have it out here right in the first part of April. and then I run a couple of clients, and 2 out of the 3 actually saved a little taxes. That third person, which you're looking at, did not save any taxes. And so it's kind of discouraging. But again, I must recognize I live in one of those 5 states that $10,000 limit on California tax and property tax is impacting. And so without children at home and getting that extra deduction and the loss of the exemptions, it's going to make a difference. Now, we also saw where we easily could make some changes this year in what we do and lower our taxes, and I would have a tax saving. But if I don't act, I'm going to pay more. So the point is, every one of you who's listening to this, we encourage you, as soon as you get your 2017 return, find some way to get it over to us. Our software is not for preparing the tax return, and it won't be perfect, but it's a planning stuff that we can get a really good idea if we move this or do that we can really reduce the taxes, because there are opportunities in this tax bill.
Yeah, there's definitely opportunities, and we think everyone should take advantage of planning now so that 2018 is a little less painful come next year.
And as we suggested in the beginning, watch this video. Take some time to get your tax return out and go through it again and look at your items that we've talked about. And you might also really want to forward this to some of your friends, because I'm not sure, Jim, that most people are going to realize the impact on their taxes until they're filing it a year from now, which is way too late to make any adjustments for 2018.
Yeah, I would agree. I mean, it kind of comes back to the idea or the knowledge that this really is a landmark change in tax law, that we haven't seen such a big change since 1986. And, tax laws get changed a little bit here and there all the time, but this is so different that I think you're right. There will be a lot of people that are surprised, and it would be much better to take a look at it now rather than be surprised at the beginning of next year.
I'm not complaining, but I've not spent so many hours reading and studying a tax law since 1986. And this one is far different than the 86 return, and for a number of reasons. I don't believe anybody is going to be happy a year from now if you don't do planning during the course of the year.
What do you expect to be retired?
Well, yeah, I am retired, aren't I? Or semi-retired, but this is fascinating. Some of the things that we'll cover in the business side, and some of the things we'll cover in the next video. There's a number of things that were put in here that don't seem to be friendly to the public or to business. And that's really confusing to me. And then there's some things that pop up. If you drink beer or wine, you'll be interested in our discussion on business. But there's some things that pop up that don't make any sense. But that'll be in the business section. That'll be the Tax Cuts and Jobs Act number 2 video.
That sounds good, and we look forward to hearing from all of you.